Okay, I'm just going to rumble off some thoughts I have about the market this week. I've got the SPX 500 chart up here, and we've had a steady, kind of very nice bull move up here. And a lot of people, especially some of the pundits in the financial news media, have been suggesting that we're going to all-time highs. We're going to break above the previous highs we made last year. I'm a bit more doubtful of that, and I think there's things in the underlying economy that are making me really really nervous to bet the farm, as it were, on all-time highs. Um, One of the main things, these are the things I've sort of highlighted that I've noticed, is that the main individual stock names that I look at are not showing the kind of strength that the market is as a whole. And I found these stocks to be leading in previous rallies. And these are the FANG stocks, which is Facebook, Amazon, Netflix, and Google. And you can see by Google's earnings, the drop that even massively ripped down the Nasdaq. It was an incredible miss on earnings, and those stocks are showing the same kind of strength that the market is as a whole. And my bellwether stock that I love, Starbucks, that as well. That is very, 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 very weak in comparison. The second thing I've noted down is that when we had the February lows, we had central bankers around the world. You had Mario Draghi and you had Janet Yellen. Both, Janet Yellen eased off on the rate increases, and Mario Draghi just fucking pumped a load more QE. And it seems like the message from central bankers is what we had, last year, going into the year before, which was the whatever it takes message, which they're ready to support the markets with QE, with, in the case of the Eurozone, TRTLO. But this sort of has a shelf life in its ability to make the market rally, and I believe we're getting to a point now where this stuff isn't going to work for very much longer. And if the underlying economy is still weak, then no amount of central bank intervention is going to keep this market rallying. And I'm not making a conclusive statement in one way or the other. I know I'm known for my spectacularly shite Gartman calls, but I'm usually right on the overall broad direction of the market. And I don't see us making new all-time highs. I don't think the earnings are there, especially in US companies. And when we're talking about my favorite market, the DAX, one of the biggest sort of sectors in the German economy is the automaker market. And the German government is recalling and forcing companies to recall cars at a rate that's never been seen before. So that's going to affect the bottom line of a lot of these German automakers. And I think that's going to put increasing pressure on the DAX, which is already under massive pressure at the moment because of political decisions by Angela Merkel. And there's quite a significant gap between the DAX's year to date and the S&P 500 year to date. And I think that could be about to increase. And this isn't a market that, from what I've experienced in the past, that is going to be heading to break the all-time highs. It just isn't. And a lot of people always level the accusation of perma bear, but I don't think I've ever really been that. I see the sort of trajectory of most of these economies as negative in the very, very long term. We're talking 20, 30 years out from here, due to the betrayal of Keynesian economics and all that other crap, tinfoil hat wearing crap that I go on about. But purely trading perspective, this doesn't feel like a market that is going to rip up beyond its all-time highs, and I expect we're going to get a rejection of this trend line here in the coming next 2 weeks, because it's just not a market I've got a feel that is going to go the distance. So.